Hi everyone, Darren at Leviathan Financial Management with your weekly market report. The theme of this week has been the bond market rout, with 30-year bonds touching 5% this week, and with today's a lot stronger than expected on farms. Payrolls could be in for more of the same in the coming weeks. The S&P, however, did rally firmly on the back of today's number, even though we are indicating, as the Fed have said, that we could raise rates again. And even though the stock market rallied today, 10-year bond that is heading towards 6% will not be supportive of the market in the medium term for sure. So onwards, and basically what we're doing, we're running a scenario here. There are two places where we can focus our attention. One is the 10-year treasury notes that are made on the CME and the equivalent downside trades there, or TLT, which is an ETF which is based off of 20-year bond yields. Having said that, having run through some scenarios, one of the trades that I like here, the two favorite trades are either if you're going a longer term view, and in this instance I put on a trade in March, but looking at what would happen if we moved by the end of the year. So I've got a March expiration option, but I'm really looking to monetize this before the end of this year. Systems come up with the best trade that it recommends is the 98.50 put spread. This is because even though if the target is 100, which is what we've implied here, which would be the equivalent of a 6% yield in the 10-year note, then that would be equivalent to 100. And so that has been my target price. I'm putting a wide landing pad of 5% around that. And so if I want to carry this on into the new year, then this is going to be the best trade to do. The 98.50, 98 put spread doesn't get to par, but it's still going to have premium because there will still be plenty of days left before expiration. This would give me a 726% return on this trade. Basically, it's currently ranked in its 37th percentile when looking back at this equivalent out-the-money trade compared to other times in the past. And given where we are, that's actually not too bad level to get into. If you do that, you're trading at fair value. The other one, if you want to have a higher return, would be to do something in a shorter dated expiration. Here, I'm targeting 100 again, same principle, looking at 6% yields in the 10-year. And the two trades, very similar returns. But the ones that I like is probably, again, a put spread. It's nice and simple. It's a 198.50 put spread. We are looking at a target date just 45 days from now, basically targeting that expiration. If this one came to fruition, you would make a 2,000% return on that particular trade. And let's have a look at this particular trade here. On this one, and the heat map, green is good, red is bad. It works for you in slightly better in a higher vol environment on a shorter term basis. But you can see where you'll start to, basically we come off, you're going to start to monetize this pretty quickly. And it has a lower risk there for you. So personally, I still like the March. It's longer dated. It gives me a little bit more leeway. It doesn't have as large a return on investment, but it gives me longer to play in the sandbox. And as we can see here, if you look at the heat map, there's even more area that is green, which is always good. Depending on a high vol environment, this trade will work well quicker. So yeah, I quite like this trade in March. The 98.50 put spread, if you can buy that one. I did run a TLT equivalent for you to look at. And you can see some of the trades here are not implying as large a return as you can get out of the equivalent trades on the CME. Some of you may not even actually be able to trade future-based options. If that is the case, reach out to me. We will look at other potential trades that could be done in more an ETF-based world. But anyway, that was a trade that I like. Other things to look out for next week is we have CPI and PPI. They are inflation numbers. The stronger they are, will compound the idea that the Fed will continue to raise rates. If we continue to raise rates, it's going to be better off for you to stick your money in things like that are locked in and are safe, as opposed to stock market. So if we're going to continue on this trajectory, I can see trouble in both the stock and bond market as things would get a bit rocky for the economy if we got anywhere near those kind of levels. Anyway, that's it for us. Good luck trading as always, and yeah, have a great weekend.